Joining us to discuss this morning, UBS Private Wealth Management's Alli McCartney's here at Post 9 and Columbia Threadneedle Investments, Ernesto Ramos. Happy Friday, to the degree it's a happy Friday, Alli.
We'll see.
What is the talk that you hear about how FedEx fits in the whole puzzle?
Well, I think you're asking all the right questions, which is how much of this is a macro foreseeing of the future, where we have all of this data that's backward looking and we're finally getting something that's sort of the moment looking forward, and how much is micro, how much has to do with the actual company, right? And last week with the CPI print, what we've started to see with the re-rating of what interest rates may look like is we've started to see a shift in the narrative from, yes, we can see a soft landing, to what is the recession going to look like? And so we are at the point now where we have 9 central banks reporting next week. We have, all kinds. You're talking about murky data. Data is all over the place, and it's not clear, again, which one are really representing micro factors and which one is representing macro factors. And so, look, if I represent individual clients, and right now I can buy a 6-month T-bill that's yielding 3.68%, and not pay state and local taxes, that's my best idea, and that's a really tough place to be, as an investment professional. But you gotta wait this out. Murky is the right word.
That's interesting, Ernesto. We, after years of saying there is no alternative, wouldn't you agree that stocks have real competition now?
Oh, it's quite a tough environment right now for stocks. With the combination of interest rates rising and GDP slowing, you have to focus on fundamentals at the stock level and try to put the macro picture, or take the macro picture out of the equation. And we like stocks in energy, healthcare, profitable tech, but you have to be real careful and pay attention to what you're buying and how much you're paying for it, because the macro environment is tough. Now, the silver lining here is that as rates have gone up, it's created an environment where stock pickers could start to shine again, despite all the last few years being all led by passive type vehicles like ETFs. So we see an opportunity here for stock picking, but the picture of the market as a whole, the beta picture, shall we call it, is murky, whereas the opportunity for stock picking is bigger than it has been in quite a few years, and that's what we like about this environment.
Yeah, well, Alli, then to that point of stock picking, I mean, it's been a brutal week for those at least who are long stocks, and certainly any, let's call it growthier or technology stocks, with the NASDAQ down again 1.7% today. To those who'd be tempted to pick off some names they think have gotten cheap, what would you say?
Yeah, I think, I agree wholeheartedly. Energy and healthcare and consumer staples are the places to go. The energy picture has been strange, to say the least, given all of the structural supply issues and the challenges. The fact that energy has not been working and that we've seen gas prices go down, we think is much more of a sort of short-term noise than a long-term trend. So getting in that space, especially when you're talking about healthy MLPs and stocks that have taken their debt level down, yielding some tax advantage well above market rates, that's interesting. Healthcare, if you're going to play in the stock market, whether you're doing it actively or passively, short-term or long-term, you have to get into defensive and quality. It may not work for a day. It may not work for a week. But, because trends are really breaking down everywhere. But I think you have to have a decent time horizon, not a day or two, not a week or two. And you have to lean in at this point.
What does it mean when you say
value.
Trends are breaking down everywhere?
I think, look, and you see it all the time on this show. You have technicians talking about, we're about to go, if we hit 3,800, we're going here. If we see this, we're doing here. If quality performs, then this should. Those things are breaking down on a minute-by-minute, day-by-day basis. You can say that's because of algorithms. You can say that's because you don't have economic buyers right now. Whatever you say, a lot of what's been behind us is not what's in front of us. Let me give you a data point there. So 2% of the time on 12-month rolling, you have seen fixed income and equities down at the same time. We're in that 2%, right? So the world is not functioning as it used to. Algorithms are not functioning. Humans are not functioning and investing the same way. So you have to think differently, and part of that is a time horizon issue.
Ernesto, is that what you're telling clients, that long term? I mean, the debate's been going on for a while now about the longevity of 60-40, but is it truly gone?
Well, right now it is, but it won't be forever. In fact, we think that right now, as our other guest is saying, you have to be long term because stocks are going to be in for a bit of a rough next 6 to 12 months. But again, the uncertainty that's being created by the fact that we're in a whole new world, basically, in terms of rates and valuations. And rates rising, we haven't seen that in 40 years. So we're going to have to adjust to that. And all the forecasts of the macro is full of uncertainty. And we just got to get through that. And we have to see the end of the rating cycle before stocks can resume their path upwards. But there will come a time when that happens. And you have to be patient. You have to wait at least a number of years. You can't buy them today and make money over the next couple of months necessarily. But if you're patient enough, you will make money. And that's what we're telling our clients. Just buy and hold, and don't look at your statements every month because you'll drive yourself nuts, and it's not healthy to do that.
Ali, Ernesto, thank you guys. Good to see you both.